Often what we see is a lot of businesses who maybe find an error in their plan are surprised at what potential penalties can come with a retirement plan error if it's not dealt with correctly.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Hansman Weeble. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. Today we are joined by Quentin Knott to talk about employee benefit plans. Thanks for being here, Quentin.
Absolutely.
Can you tell us a little bit about yourself?
So I'm an audit manager here at Hansman Weeble, and I have been here for about 5.5 years. And I do a lot of for-profit audits along with a good number of employee benefit plan audits or retirement plan audits, and then do a good bit of tax work as well.
All right, so we're going to jump right in. We hear about employee benefit plans all the time. Can you tell us about the different types of plans and why an employer would want to offer one?
Sure. So today there's really two buckets of types of plans. There's defined contribution plans or DC plans and defined benefit plans or DB plans. And these days the most popular are the defined contribution plans. That's going to be your 401k, your ESOP, employee stock ownership plan, a profit sharing plan. Those are kind of going to be the defined contribution plans. And what those are they are plans where the contribution that an employee puts in is defined on the front end, but the money they can take out on the back end is not defined. Whereas a defined benefit plan, the benefit is set based on a formula that the employer has stipulated. And in a defined benefit plan, the employee knows if they stay for X number of years, this is the benefit they receive on the back end. So with a defined contribution plan, the risk is often seen to be with the employee because the employee does not know how the market will perform, and whatever money they put in, they are not guaranteed that they will get it back out. And then with a defined benefit plan, the risk falls with the employer because they don't know how the market will react and they don't know how their business will react, but they do know that if their employees stay for this many years, they will owe those employees that amount of money.
So it's kind of built into the name benefit, right? So
Exactly.
Providing a benefit to your employees is one of the key reasons, obviously, for retention.
Right, and that can be true for both plans, and both can be used to market in different ways. With a defined contribution plan, an employee may know that if they put in X percent, that their employer is going to match them X percent. An employer can also have, under a defined contribution plan, a profit-sharing contribution, where whether an employee is contributing or not, they can set a dollar amount, often annually, and give it to every eligible employee, which is another way to retain and sometimes attract some of the best talent in their industry.
What about the tax benefits of providing a plan?
Right. Well, the tax benefits are twofold. For the employee, they're often able to choose whether to contribute pre-tax or Roth contributions, which have varying tax benefits, some in the near term and some in the long term for employees. And for the employer, there is some tax benefit if they're providing a match or making any sort of contribution that is a deduction they can use for tax purposes.
Who monitors and regulates the type of plans that we just talked about?
So there's a number of governmental agencies that oversee retirement plans. One of the biggest ones is the Department of Labor, or the DOL. The Employee Benefits Security Administration, which is the agency of the DOL, which kind of oversees whether retirement plans and health plans are complying with ERISA, which is the Employee Retirement Income Security Act of 1974. And really, ERISA is kind of the main federal law that sets a lot of the minimums for what retirement plans need to comply to.
So definitely a little bit of alphabet soup here.
Absolutely.
Have there been any major changes since the Act went into effect?
One of the most relevant changes that came with Secure Act 2.0 in 2022 was the requirement of which retirement plans need an audit from a third party. So the old rule was that if you had more than 100 employees that were eligible to participate in your retirement plan, then your plan needed an audit. Now the new rule is that if you have 100 participants with an account balance in your plan, then you need an audit. So that's a pretty big distinction.
Yeah, so we've probably seen maybe a handful of clients, or maybe significantly more when you think about the industry as a whole, people who no longer need to have an audit within their plan.
Exactly.
So we've talked about the audit process. Can you tell us a little bit more about what that looks like?
Yeah, so when we do a retirement plan audit, we're looking at a couple of things. Normally, the first thing we do is we look at the plan documents, or the adoption agreement, or the summary plan description, all of those documents that are kind of the core of how a retirement plan is supposed to run. And every single retirement plan has their own documents where they've made their own elections on how they're going to run it. So we normally get to know those stipulations, and then next we look at a company's policies and their procedures and see how they say they are going to achieve all of those elections that they've made in their plan documents. And then after we kind of have an understanding of a plan's documents and a plan's procedures, how it operates, we typically look at some of the more high-risk areas and do a little bit of detail testing to make sure what is said to be happening really is happening under the surface.
Are there any other components of the audit process?
Sure. So when we finish an audit, typically what we give back to a client is a set of audited financial statements, and what they will do with that is they will attach it to their Form 5500 filing. So that's kind of the end of the audit process. You have a set of financial statements in hand that we have assisted the client in preparing, and then they are attaching it to the Form 5500, which is filed with the Department of Labor.
What about deadlines associated with that 5500 filing, which then in turn dictate deadlines for your audit?
Right. So whether you receive an audit or not, your retirement plan likely has a mandatory filing requirement of a 5500 or a 5500 short form, or SF, and that is 7 months after year end. So if you were a calendar year end, your deadline for your 5500 is July 31st. And it's really easy to get an automatic extension, which would push that deadline out to October 15th.
So not only the audit process itself sounds like it can be complicated, but just the types of plans that people have as well. Do you have any tips to help streamline the audit process?
Yeah, the first thing I would say is that every business should have their relevant plan documents handy, and those who are administering the plan, either as the plan administrator or the primary fiduciaries, should make sure that they know what rules are in those plan documents and ensure that the business is set up to follow them. Often what we see is a lot of businesses who maybe find an error in their plan are surprised at what potential penalties can come with a retirement plan error if it's not dealt with correctly. So what I would suggest is that if any business finds a potential issue within their retirement plan, they should reach out for help as soon as possible.
Because you certainly don't want to wait until the audit process
That's
and
right.
have your auditor find that error.
That's right. You're not going to want to find it in an audit, and you're especially not going to want to find it in an IRS or a DOL audit.
Well, thank you so much for your time today, Quentin. This is very helpful information.
You're welcome. So what's the next topic?
Well, it depends.